You know, the US Treasury market, it's the bedrock of global finance. It's the ultimate safe asset, the benchmark for pretty much everything. But a truly monumental shift is underway. A change that the SEC is calling the most significant rewrite to this market structure in decades. Okay, let's dive into what's happened.
So, what happens when the world's safest asset just breaks? It's a question that keeps regulators up at night because it's not just a hypothetical. It's a question the market has been forced to grapple with more than once in just the last 10 years.
And wow, just look at this chart. This shows you exactly what that looks like. In March of 2020, during the dash for cash, everybody tried to sell their treasuries all at once. The market just seized up. These huge spikes you're seeing, that's the gap between buying and selling prices blowing out. It suddenly became incredibly difficult and expensive to trade the world's most liquid asset. It actually got so bad, the Federal Reserve had to step in with massive support to stop a full-blown collapse.
Now, here's the really important part. That 2020 event wasn't some random fluke. It was really the culmination of a whole pattern of stress events that showed some deep structural cracks in the market. You had the flash rally back in 2014, the repo funding pressures in 2019. Each time, the plumbing of the market creaked and groaned, and it got to the point where regulators decided that a fundamental overhaul wasn't just an option, it was a necessity.
So to really get why this solution is so important, we first have to understand the problem. Let's take a quick look at how the market has been working up until now. This chart right here tells a huge part of the story. See that tiny blue slice? Only 13% of the cash treasury market is centrally cleared. That huge green area, a massive 68%, represents trades that are what we call uncleared. And that just means the buyer and seller are dealing directly with each other, handling all the risk on their own privately. And it's pretty much the same picture over in the repo market, which is absolutely crucial for keeping the whole system liquid. That first bar shows the huge volume of uncleared trades. It completely dwarfs the cleared volume in the second bar. So again, you have trillions of dollars in risk being managed in these one-to-one behind-the-scenes arrangements. And you don't have to take my word for it. The SEC spells it out right here. This fragmented system creates a ton of risk. When every single firm has its own different rules for managing risk, you end up with this opaque, inconsistent web of connections. If one big player fails, nobody is really sure who's on the hook and how far that contagion could spread. So all of that brings us to the SEC's big solution, a mandate to force the vast majority of these trades out of the shadows and into the light through central clearing.
The hero of this new system is the central counterparty, or CCP. The easiest way to think of a CCP is like a universal, super secure escrow agent for the entire market. It literally steps into the middle of every single trade, becoming the buyer to every seller and the seller to every buyer.
And this diagram just perfectly shows that shift. Before, you had this complex, messy web where one firm's failure could set off a chain reaction, a domino effect. After, all that risk is funneled to one central point. If a firm defaults, the CCP steps in, uses that firm's collateral, and makes sure the rest of the market keeps running smoothly. It basically acts as a system-wide firewall.
So, the SEC has 5 big goals here. First, centralize the risk to reduce that chance of contagion. Second, standardize the rules to manage defaults better. Third, and this is a big one, they can net trades together, which drastically cuts down on the number of individual transactions, freeing up balance sheet space for dealers. And finally, it gives regulators one clear window to see all the risk across the entire market.
Now, making this vision a reality is, well, it's a Herculean task. Let's look at how this is actually going to be implemented.
The scale of this change is just staggering. By some estimates, this new rule is going to force an additional $4 trillion in daily transactions to be centrally cleared. Think about that. That's a massive operational, legal, and systemic overhaul for the entire industry.
So here's the roadmap. The original deadlines were even tighter, but recognizing just how complex this is, the SEC gave everyone a 1-year extension. The key dates to watch are now the end of 2026 for cash trades and then the middle of 2027 for the repo market.
For decades, one company, the Fixed Income Clearing Corporation, or FICC, has been the only game in town for clearing treasuries. But this mandate has completely changed that. It's opened the door for new competition. We're talking heavyweights like the CME Group and ICE setting up their own clearinghouses. Now, this could be great. It might lead to innovation and lower costs. But it also adds the new complexity of having a multi-CCP world.
Okay, so what does this all mean for the future of the world's most important market? Let's break down the outlook.
You really have to see this as a balancing act. On one hand, the huge potential benefit is a more resilient market with way less systemic risk. But that safety comes at a cost. Firms are now going to face much higher upfront capital requirements because they have to post margin with these CCPs. And there's a real risk that some smaller players might find these costs too high and just exit the market, which, could actually reduce competition.
And one area regulators have been watching like a hawk is the basis trade. It's a popular hedge fund strategy that uses a lot of leverage in the repo market to profit from tiny price differences. By forcing these trades to be centrally cleared and, crucially, margined, this mandate completely changes the economics of that strategy. The goal is to cut down on all that hidden leverage building up in the system.
So why go through all this trouble? I mean, why does this matter so much? Well, this chart says it all. This is the projected growth of U.S. government debt. To fund this massive and growing mountain of debt, the country absolutely needs the Treasury market to be as stable, liquid, and efficient as it can possibly be. A market that can't handle stress isn't just a market problem. It's a direct threat to the nation's ability to finance itself.
Which leaves us with the ultimate question. The whole goal here is to make the system safer by dragging risk out of the shadows and into a centralized, well-managed place. But financial history has taught us that risk is kind of like water. It always finds a new path. The real test of this reform will be whether it truly neutralizes risk or if it just forces it to pop up somewhere else in some new and unexpected way.
This is not financial advice.